The Reserve Bank of India just announced its latest monetary policy and the market is watching every move. Repo rate unchanged, inflation revised sharply down, growth upgraded, and a big push for rupee internationalization. What does all this mean for your money, your stock, and Indian economy direction? Let's decode the entire RBI MPC outcome in simple terms in next 5 minutes. The 57 RBI Monetary Policy Committee meeting held on September 29th of October to October 1st, 2025 was all about balance, growth on one side and inflation control on the other. RBI has decided to keep the repo rate unchanged at 5.5%. That means no change in your loan EMI for now, but a clear signal the central bank is comfortable with the current inflation trend. The policy stance remains neutral, not tightening, not easing, giving RBI room to react based on upcoming data. Inflation forecast for financial year 26 has been revised down to 2.6%, which is huge positive. At the same time, GDP growth has been upgraded to 6.8%, showing strong confidence in Indian economy. Now here is where the real reaction is liquidity management. RBI will continue to use overweighted average call rate, what we call WACR, as its main operating target. Liquidity operation will now shift focus to 7-day operation instead of 14-day, giving RBI move flexibility to manage short-term money flows. Standing deposit facility and marginal standing facility rates remain unchanged, maintaining a stable interest rate corridor. These steps may sound technical, but in simple terms, it's about ensuring smoother transmission from policy rate to market rate, making sure the money system flows efficiently. One of the most interesting part of this policy is RBI's push to internationalization of Indian rupee. Under the new framework, Indian bank can now lend in rupee to neighboring countries like Bhutan, Nepal, Sri Lanka for trade. RBI will also start publishing reference exchange rates for partner currency like Indonesia, rupee, UAE dirham, reducing dependency on US dollar. Plus, foreign entities can now invest their surplus rupee balances not just in government bond but also in corporate bonds and commercial paper. This move could make the rupee more visible and powerful globally, slowly positioning India as a stronger player in regional trades. So, how does this impact markets? The tone of this policy is pro-growth but cautious. Stability in rate support sector like real estate, consumption and auto. With the bank and NBFC will benefit from steady credit demand. Bond market may rally in inflation low, and the rupee could strengthen on increased trade uses. Overall, is the policy that offers stability now and optionality for future costs, exactly what investors love in uncertain global environment. Repo rate unchanged at 5.5%. Inflation seen easing to 2.6%. Growth upgraded to 6.8%. Rupee internalization gets a major push. RBI stays neutral but flexible. The message from the central bank is clear. We are ready for the growth, but we will stay prepared for the uncertainty. Keep an eye on inflation data, global rate, and next MPC meeting. That is where the next big trigger for the market will come.